Good afternoon, everyone, and welcome to day two of iFAST Financial India's Invest Globally and Profitably 2021. We had a very exciting day yesterday with some very good poll participation and some very insightful questions being asked. Thank you, and please keep the buzz going today as well as we present our global model portfolios as well as insights into the emerging markets and developed markets like Europe and Japan. As like yesterday, I'd like to start the day with some important announcements. A recording of yesterday's sessions as well as the presentations are available for download at the iFAST Financial India booths under sponsored exhibits, so please do access that. A reminder to all of our attendees who are certified financial planners and certified wealth managers to stay tuned as they stand to earn learning credits from the sessions they attend with us. After the event, we will be sharing your data with our knowledge partners FPSB India and AFM India. They will issue the learning credits based on verification of the memberships. All right, now back to the good stuff. Yesterday, we heard a lot about digital innovation. Now, even before the pandemic, digital technology was seeing a lot of rapid adoption. The reason is it can simplify a lot of complex and multi-party processes. So many of our transactions that would earlier take days or even weeks because data had to travel from one company to another, be reformatted, verified, and then processed. All of this can now happen in a matter of hours. For those of us in the wealth management industry in India, this is actually an exciting phase as we're discovering newer capabilities like seamless transactions, fee recovery, and compliance. At iFAST Financial India, our focus has always been on enabling growth of financial intermediaries with innovative tools and compliant processes. I'm very excited, ladies and gentlemen, to present a sneak peek into the latest digital capabilities of the iFAST 2.0 platform. Let's take a look. Exciting stuff, guys. Please do check out more demos of iFAST 2.0 from our booth. Now, yesterday I promised you a deep dive into the emerging markets investment basket. We start off today with a presentation by Ong Ziyan, Senior Macroeconomic Analyst from iFAST Financial Singapore. We've also opened up the first poll for the day, ladies and gentlemen, so please do send in your responses. Over to you, Ziyan. Welcome.
Hi, good afternoon, ladies and gentlemen. Thank you for taking your time out of your schedule to join us here for our investment webinar today. I'm Ziyan, a Senior Macro Analyst with iFAST Singapore. And today I would like to take some time to zone in deeper into the emerging market, a segment of the equity market which we feel most optimistic about this year. I think to start, we can take a look at the performance of the emerging market last year. you can see that despite being beaten down quite badly during the COVID sell-off in March, and sort of lagging in recovery compared to the developed market like US and Europe across the middle of the year, the picture actually started to look a lot better and a lot brighter than the rest of the world looking into the later part of 2020. In fact, in the earlier part of this year is when we are starting to see a lot of this outperformance in the emerging market. And we think that moving ahead, this outperformance will continue to persist. I think we believe that 2021 will sort of mark a global reflationary environment where the economic growth starts to recover post the COVID recessionary environment. It's also important to note that a lot of this 2020 economic contraction last year is mainly attributed to the COVID pandemic. And as we're speaking, the mass vaccination programs that is sort of rolling out across the world could potentially accelerate a lot of this growth rebound that we expect to see. And I think growth rebound after any recession, if you take reference to the past crises like the Great Financial Crisis in 2008, the growth rebound tend to be very strong after a recession, and usually often above the historical trend. So looking ahead, we can expect that the same situation will start materializing for the world this year as well as next year. I think it's also important to note that there's a lot of pent-up demand, a lot of discretionary spending that could be unleashed back to the market once things start to improve COVID-wise. I think, yep. So with this, we also think that earnings will start to improve massively this year. If you look at it in terms of the EM market, because of the cyclical exposure towards a lot of this beaten down sector. So a lot of transient factors, such as a lot of temporary factors of your short-term decline in last year, as well as the year before, results in a very low base effect, where a lot of your EM markets like your Latin America, your Asia emerging market, provide them with actually a very low bar to clear. So looking ahead, we think that the cyclical earnings per share recovery will be pretty significant and will be a very key driver for the EM equities. I think looking ahead in this global reflationary trade, a lot of the by sector, you can see that within the emerging market, all the way from Brazil to your Turkey, a huge component actually ties in with your financials, your energy, your consumer discretionary. And a lot of these sectors and companies were the ones that was beaten down really badly during the COVID pandemic. A lot of your financials actually went down on 20 to 30% kind of drawdown. Your energy players were actually down by almost more than 50%. And not because of that, I think this low base effect, we're going to see the EM being able, the tables will start turning around for a lot of these EM. And based on the sectorial mix, because of this cyclical tilt towards this more cyclical sector, more economically sensitive ones, the sort of the global rebound post-COVID will be will be expressed the most impactfully within the EM. And I think there's actually quite a few macro tailwinds that are supporting the EM equities. Firstly, I think the US dollar have been heading downwards, have been contracting in terms of strength for a while. And we expect this, and if you look at it in the past 30, 40 years, you can see that the US dollar strength actually moved in terms of a cycle. And moving ahead, we can expect that the dollar weakness to continue ahead. I think not just because, I think one of the key most near factor would be that the Federal Reserve, the central bank in the US, will continue to print more money using their quantitative easing to help boost its economic growth or support its growth at this point of time. I think the chairman, Powell, actually came out to reassure the market participants that a lot of this supportive measure remains to be something that they are looking at and will be willing to deploy them whenever they think it's necessary. And one of the key thing about the dollar weakness is that it's actually very supportive for EM equities. You can see based on the trend for the last 20 years that every time the dollar weaken, EM equities actually appreciate very sharply in price. So in this dollar bear market, we think that it will actually provide a very strong base for EM equity to outperform that of the DM market. And I think one of the key reasons why is because a lot of your EM markets actually hold dollar denominated debt. So when your dollar start to weaken vis-a-vis a lot of the local currency, the EM currencies like your real, your renminbi, is that a lot of these EM countries can actually be able to pay off their financing costs a lot easier and actually improve their sort of profit margin in the long run at this point of time. So at the same time, the second factor that we see that's actually driving the EM equity is actually the rising commodity prices. If you have been following the news frequently recently, you have seen that copper prices, iron ore prices are hitting multi-year high, near decades high. And I think this is to show that it's sort of an early signal that the world is starting to recover. A lot of factory activities are starting to pick back up. And not only that, a lot of governments that are using fiscal policies to kind of stimulate their economy are going through a lot of infrastructure building, which means that they'll require a lot more of this basic matter, a lot of fuel to kind of boost your economic growth. And the good thing about that is that your EM equities, especially your LATAM, your EMEA, your Asia, like even ASEAN, is that a lot of these economies are fundamentally commodity exporters. So because of these rising prices, it was going to be a very, very big boost for your EM equities as a result. I think your commodity prices, I think not just in terms of, because as an EM, the EM equity is sort of a proxy towards the global growth. That's not just on a sentiment side. In fact, in terms of fundamentals, when your commodity prices improve, because of how cyclically tilted a lot of your EM indexes are positioned towards, the rising commodity prices actually help fundamentally boost corporate earnings. If you've seen over the last 15 to 20 years, it's actually a very, very close correlation. Whenever commodity prices start to pick up, earnings actually start to pick up. So right now, I think there's a lot of concerns that equities all around the world are kind of at an overheated valuation level. But when your earnings are starting to pick back up, your expensive valuations aren't going to look that expensive anymore. And in fact, versus the DM, EM is still trading at actually quite a substantial discount in terms of valuation. So there's a lot of positive catalysts lining up for EM this year. And I think to zone in a little bit deeper, we are actually quite favorable on Asian EM. I think one of the a special mention goes to South Korea, which actually done pretty well for this entire, in fact, from the start of 2020 all the way to this year. In fact, in terms of a single market performance, it's up about 40%, a lot better than the rest of the other markets. And it has to do with a lot of your tech and your tech and electronic kind of exports. I think the sort of this tech heavy market actually recorded the exports actually started to pick up quite strongly. And looking ahead, we actually think that this will continue to be a main driver for the South Korean equities. Right now, if you've been following the news, you've seen that the global chip shortage is something that is plaguing the entire industry, in fact, the auto industry. And South Korea, being one of the key components is Samsung Electronics, actually one of the leading foundries that is capable of producing a lot of these semiconductor chips. And looking ahead with this chip shortage, we think that not only are these chip exporters being able to export even more chips, they are actually started to raise prices on a lot of your chip components, like your DRAM prices, your NAND, your A6 chips are all starting to pick back up from the later part of last year all the way to the start of this year. And we think that this trend is starting to move even more strongly ahead, especially when the rest of the world, in terms of economic growth, starting to pick back up. I think in terms of key trends, we think that say your 5G upgrade cycle in terms of a smartphone, your Bitcoin mining rush with the fact that Bitcoin is actually up more than 60 to 70% year to date, are key drivers for a lot of your semiconductor chips. And I think in terms of outside of Asia, we are actually quite favorable on your Latin America as well as your EMEA. So in Latin America, we think Brazil is quite a good spot. Firstly, performance is actually quite lagging versus the rest of the EM. And a lot of the commodities are actually your metal, your iron ores are all coming up from Brazil, this region. Of course, at this point of time, there's a lot of idiosyncratic factor that is weighing it down. But we are over the longer term, maybe 1 to 2 years out, we think that Brazil can actually start to pick back up very strongly and be able to realize about a 30 to 40% gain in terms of performance. So I think the other market that we are quite big on right now is actually Russia. Russia is actually a big winner for the higher oil prices. So the upside, we think that earnings revision has been actually quite aggressive downwards for this market for a while already, and this earnings revision could potentially move towards a more positive end given these higher energy prices. At the same time, it's also one of the EM that provide one of the highest dividends percentage, around 3 to 4% across the rest of the world. So while waiting for the prices to pick back up, investors are actually compensated with your high dividend yields. I think, so this actually wrap up my presentation. Overall, for 2021, we think that this is actually a global reflationary environment, and economic growth to start to pick back up. Although there's a bit of concern right now in terms of valuation, and you're seeing markets selling down because of the rising 10-year bond yields. We think that this is probably just going to be a very short-term adjustment. And looking ahead, EM is well positioned to take advantage of sort of the global economic growth. And we think that investors who are looking to kind of position themselves to the future needs to include more and more EM into their portfolios right now. And in fact, any kind of dip or any kind of correction within the market could be actually a good opportunity to accumulate a bit more exposure into your Asia EM, your Latin America EM, as well as your EMEA kind of region, selected few markets that will benefit from sort of the commodity rush, your economic reflationary environment looking ahead. With that, I've come to the end of my session. Thank you for your attention.
Thank you so much for your insights, Zian. Can we now look at the poll results, please, for the first poll of the day? Okay, while that comes up, let me introduce our next panel of experts. Okay, here we are. Well, yeah, I did expect this would be pretty close. So this is going to be an interesting panel, ladies and gentlemen, because we have experts here to debate this very same point. Let me welcome our panelists. We have Rajesh Krishnamurthy, Country Head India for Financial Planning Standards Board Limited. Hi, Rajesh. We have Ashwin Patni, Head of Product and Alternatives from Axis Mutual Fund. We have Manish R, Head of Product Communications from ICICI Prudential AMC. And we have Ong Ziang again, Senior Macroeconomic Analyst from iFAST Financial Singapore. Good afternoon to all of you, gentlemen. Over to you, Rajesh.
Thank you, Deepali. It's always a great pleasure to be with friends whom you know in the industry and also with friends you will make in the industry, right? Thank you. Manish, hi. Ziang, good to see you. Hi, Ashwin. Uh, we have a very interesting thought, uh, and that's a thought that's going around in everybody's mind, which is about whether India is a place to invest, whether emerging markets is a place to invest. Would emerging markets do better than the world? Why? So many questions. And I guess what better than just handing over the mic to each of you and just getting you to go with the flow and answer those questions, right? So let me just try and start with the alphabetical order. Ashwin and Jiang, I'll come last to you. Uh, Ashwin, so I mean, to make it very quick, if you were to just give one important pointer as to why emerging markets will do better, what would be that one thing?
So thanks for that. Let me kick off by saying that frankly, in a long-term perspective, what we would the way we would like to see it is that uh, investing in EM is not about looking for whether it will outperform or underperform India. The idea is to actually find broadening of opportunities. Can we look at countries which can give you access to opportunities which you don't get in India? And that is where really global investing and of course within that EM investing should be seen. To respond to your question, what is that theme? I think briefly was covered in the previous session also, but I think clearly the most exciting opportunity within EM is of course the OTAN region. And clearly that is something that would be investors should look at very carefully to be able to take more view on EM, because China really dominates the entire EM space. And it has a lot of interesting listed companies. There are a lot of interesting themes there. And that is one thing for investors to keep an eye out.
Ashwin, Manish, what's that one thing, Manish?
Uh, Actually, I think it's not one point. I think there are so many points which are creating a conducive environment at this point of time. Why we should consider emerging markets at this point of time, and probably I think I'll take 2 or 3 minutes and just jot it down those pointers. And I think the previous speaker has also beautifully picked it up. What are the elements which are creating a conducive. I think first thing which we need to look at is the kind of global liquidity conditions which has been created by the central banks is massive. And if I say that, if you put together the major central banks, when we are talking about European Central Bank, ECB, or we are talking about the Fed, or we are talking about the Bank of Japan, last year, that is calendar year 2020, they have pumped in a liquidity almost close to 8 trillion. And I'm saying that's massive when you're looking at in that context. So point number one, the global liquidity. Point number two, if you look at the stimulus measures which has been provided by again the G7 countries is massive again, and there is negotiation going on whether we should go, whether US should continue with the 1.9 trillion fiscal stimulus measure or not. So the point number two is fiscal measures which has been provided. Uh, if you move ahead, if you look at the vaccine development which has started, especially in November when we have seen Moderna and Pfizer came up with an efficacy of 95%, that is something again very positive for the growth. That is very positive for how the reopening of the economies can happen. And one more element, I think it's slightly dated, but it's important to be highlighted here. You remember the election which has happened, US Fed election, and which Biden coming into picture. That is also something which is very positive for fiscal stimulus or measures. I think these 4 5 points, if you put together, is something which is creating a very solid, conducive background or an environment for the emerging market to perform. So with that, I'll hand it back to you.
Manish, Ziang, over to you. What's the news from Singapore then?
Okay, we actually more favorable on emerging market as a whole versus in India. I think for the points for emerging market, you guys probably have heard from my presentation. So before I'd like to zone in a bit more why we favor. Firstly, I think EM being a whole diverse region provides a little bit more diversification in a way. as compared to India having its own idiosyncratic risk. I think India itself, valuations are really high. The performance is pretty great for and I think I do like India for a lot of its cyclical exposure towards your financials, your industrials. But one of the key things for India is that oil is actually quite a main source of imports. So with prices at oil prices starting to pick back up, you'll start to eat in a bit in terms of the margin for your oil refiners. And that will sort of weigh down in terms of input costs, in the rising input costs in terms of the entire profit margin of your India equities. And as your earnings, even though as your revenues start to pick back up, your earnings may not see the kind of robust rebound that you would like to expect of emerging market within a global reflationary environment. And I think ultimately it has to do with the frothy valuation right now. So probably set up to so investors who are investing into a bit too much or overweight into into your India equities are quite vulnerable to a near-term correction, which could be healthy for the long run, but as an investor, you would not be that happy to sustain that kind of correction in terms of your portfolio.
That's interesting, Jiang. Thanks for that. So, Manish, let me come back to you. There's always this. So I'm more trying to make it very simplistic in the question, but I'm sure you have all deep answers. Pretty much everybody talks about a country's growth, and GDP being the key indicator there. Whether it's real or nominal, there is always an eye on GDP. So, do you really see that there is any kind of relation or no relation between the expectation or the actual GDP growth that one is seeing and the kind of run-ups that we are seeing or the sell-offs that we are seeing in different markets? Especially in the context of emerging. Is there some perspective you wanted to throw there?
Yeah, I think that's a very interesting question, and I think this has something which has we've been asked many times in the last, I think, 6-7 months, especially post the COVID correction, and after that you have seen the market going just one level up, and people were asking questions. Oh, your GDP is still down by 9.5%. How come you're seeing your market still growing like that? And I think the answer over here is that when you look at GDP, when we talk about GDP per se, we are looking at the complete picture. We are also looking at SMEs, MSMEs, which are not listed, or we are talking about GDP. We are also talking about services like a housemaid. We are talking about services like a person who is doing a gardening, etc. So GDP includes all those services, includes all those SMEs, MSMEs, which are not listed on the companies. So when I talk about these segments which I've highlighted, the SMEs, MSMEs, or the, let's say, a gardener or housemaids, these daily laborers or wagers, those are the part of the economy is something which is hit very, very badly because of COVID. And that has clearly got percolated into the GDP numbers or GDP figures. But when we look at the equity markets, this is something which we are talking about companies, people who are there in the white collar job, people or companies which are listed. We are talking about the large caps, mid caps, small caps companies which are well established. For them, the COVID impact was not so brutal as compared to what has happened to other side. So that's why you see the equity market, which is a representative of a very certain strata of the economy, has done very well because they have been able to do well because of all the disruptions and all that. They were market gainers, and that's why the market has performed beautifully. But in the meantime, GDP, when you look at, which gives a consolidated view of the overall economy, including all the strata of economy, that has been something which is corrected. I think that should give that divergence here.
Interesting points, Manish. I am also just trying to make my notes here as you're speaking. Interesting points. How about you, Jiang? Is there something that you wanted to add in on this whole dialogue between tracking the GDP and tracking the market valuations?
I think Manish put it beautifully in the as his points are quite clear. In fact, that's not just in the Indian market, for the rest of the world as well. So, say for example, in Singapore, the market growth is the benchmark index is not a very close representative of the economic growth. The economic growth is going to rebound, but there's a certain components such as for example Singapore, like your SIA, your airlines that are not going to recover anytime soon at this point of time. And in fact, even so, you go all the way to say your US, you can see that a huge component of its in the S&P 500 are your international companies that are more affected by your international revenue than its domestic revenue. So to say that, well, I think for a long time we like to use the index as a simplistic representation of the economy. It's not exactly a one-to-one kind of apple and apple comparison. But I think interestingly, so for a lot of your EM markets, the makeup of I would say that for a lot of your EM, like your Latin America, your Asia ex-Japan economy, their index are still a bit more closely related to this economy. So in this global reflationary trade environment, you're going to see that kind of expression in terms of a rebound being expressed a lot more closely within your EM equities. And as a result, that is also the reason why we are more favorable on the emerging market equities versus the rest of the world. And I think back to India more specifically, is that your Sensex, your Nifty 50 are just 30 to 50 of your biggest companies. So these companies they have the financial condition, your balance sheet to tide through your COVID pains. But your SMEs are the ones who are beaten very badly. So you can have your SME being beaten down, but it's not expressed in the equity market. While your larger large cap companies who have the balance sheet, they are actually taking the opportunity to take off the market shares from your SME that are dying out from the industry. So so we are seeing sort of a disparity in that case, and it's being amplified by the nature that the index is not a close comparison to the economy. Yep.
Thanks, Jiang. I mean, I'm always reminded, and when I have chats with Ashwin, he always keeps talking about why we should not be just fixated to the GDP growth, but look at more opportunities. Ashwin, you want to throw some more light on those thoughts, Ashwin?
Yes, fantastic point, because even if you take very long-term trends, and obviously speakers have highlighted what's happened in the near term with the COVID impact, but even when you look at very, very long-term in the market structure, a simple example that I can highlight is, again, to take the example of China. It was the fastest growing economy in the world in the 90s. But it had a very, very peculiar market structure where certain type of companies were listed, which were not very capital efficient and which were not terribly sort of good at generating shareholder returns. And as a result, it was, while it was, one of the best performing economies in that era, it had one of the most disappointing stock markets in that era as well. Whereas if you see today, the scenario has changed and we've had a dramatic change in their stock market. So different times, periods in time, different types of companies that are listed, the kind of companies that are, form the part of this market, I think that can really determine what happens. And that's where GDP is a very simplistic number. And I think investors should avoid that. I think the important thing that investors should look at is where the opportunities are from a listed market perspective and the kind of companies that are generating that new wave of growth which they can participate. Because equity investing, ultimately, it's all about structural growth and which are the companies and themes that can give you that.
Interesting. So then maybe, as it has to be, Jiang has to take this question then. Jiang, when you look at, leave aside the political aspects of China and India, because that's beyond our control and that's not a topic for our discussion either. purely from an investment point of view, I mean, and I would like you to be extremely open about, I mean, how an investment manager looks at the opportunity, leaving aside, the political aspects. But where do you think, this whole comparison between within emerging markets, the China and India story seems to be, from your perspective?
From from my perspective, in terms of economic growth, they actually share the same kind of benefit. I think, in fact, in terms of economic growth, India could be at a better shape. Your demographics a lot younger than that of China, and that means that for your longer term kind of growth, India will start to pick up, and will be will probably. But for China, on the other hand, for your very longer term economic growth concern is that their demographics is actually moving more towards an aging population, and they eventually bite them in terms of your economic growth. But I think, set aside the longer term kind of out view, you look at it in the near term, there's a lot more tech representation, a lot of your consumer, your internet innovation being expressed within its equity market. So your big three kind of Baidu, Alibaba, Tencent are making leaps and bounds in terms of a lot of the consumer internet kind of innovation, and they have become so big that any startup in terms of in the China environment have to go to them in order to sort of launch their business. And as a result, a lot of growth is actually being captured within these few players. And I think over the long and also I think in terms of its consumer, it's getting a lot more affluent, and they are a lot more comfortable with spending things online. It's very very similar to India, but just the index or the equity market made up is just complete. It's a little bit different. For India, it's still a bit more economically cyclically sensitive, while China is moving more towards that new digital economy that the rest of the world is heading towards. So I'll be thrilled if the India equity market start to list a lot more of your tech giants, given that the fact that India itself is, I mean, sort of a bit of a tech capital of the world as well. So but so at this point of time, I'm favorable on both these two markets. India is something that we're looking at for a while. But right now, in terms of valuation, in terms of valuation, China is a little bit more interesting, while at this point of time, India equity market is a little bit frothy, as per se. So that would be my take on these two. But these two markets are definitely on my watch list. And I mean, set aside the kind of political, that's for the politician. That's not our job. We look at it in a more pragmatic point of view. We will favor China at this point of time within market space.
I see. So, I mean, that calls in for some interesting conversation with Manish then, because Manish, I know you are you are also very bullish on the prospects that India has to offer. So, within the emerging markets, why India is a question then that beckets. I mean, we did hear Ziyang talking about it, but is there enough? So he says India is a bit frothy at this point in time. Uh, would it be bubbly? Is that going to be enticing? What do you think?
Yeah, Rajesh, thank you. I think, yeah, you're correct. I would be having a little difference of opinion over here. And I feel India is in a very good shape at this point of time. I'm really happy how India is going through its business, and probably I can enumerate all the points one by one. But I think what first thing which I wanted to highlight, because there's been some talk on valuations, and I feel that yes, when you look at 1 year forward, PE for India would be 23, 24, which is probably 2.5 standard deviation more than what we have seen long-term average. Having said that, if you compare it with the emerging market basket completely, if you put together, India is currently trading at a 35% premium to the whole emerging market. Normally, on a long-term average, India trades at a premium of 40%. So, in fact, At this point of time, we are only at 35% premium, not at 40% premium, which is long-term average. So if you compare it with an emerging market, we are not expensive. That is point number one. Second, which I would like to highlight at this point of time is that I won't be so bullish on China at this juncture as compared to India when you're putting India together, because when you look at China, China was the first one to get affected due to COVID-19 and the first one to come out also. So they have kind of in a recovery phase which is slightly later as compared to India. Because if in India, if you see that the recovery has just started, we are in the nascent stage of recovery. Uh, and in India, if you look at, we had a severe lockdown, which has a massive hit for our growth, massive hit for the supply side disruption which was created. Second, the kind of cases which we have seen in India, if you remember in September, October, was massive. Yani we were every day clocking such a high number, and we were almost about like it was just not looking like an end. So what happened is that the whole 2020, if you look at, because of these two reasons, a severe lockdown and the kind of cases which we had, India has actually underperformed the emerging market in the last 1 year. So in terms of valuations, in terms of performance, if you look at, India is still, I feel, in an initial recovery phase, and that's why I think in the coming next 1-2 years, India can perform very well. And just to extend, probably I'll take 1 more minute just to explain on the India side also. If you look at the environment which is getting created in India, which I've highlighted at this point of time, if you look at, we have a very solid monetary stimulus which is being provided. At this point of time, we have almost 6 to 7 lakh crore of liquidity which is just sloshing around in the system at this point of time. And interest rates are pretty low. We are not looking at an interest rate hike kind of thing. The budget, which has provided a massive fiscal stimulus. If you go deeper into the budget, this time the fiscal deficit is 9.5. Next year we are looking at a 6.8 fiscal deficit, and by FY26, that is 4 years ahead of it, we are still coming down to only 4.5. The earlier trajectory was 3.5. So government is very cognizant that at this point of time we have to give fiscal stimulus, otherwise the system won't be able to survive. And I think that's in place. And this stimulus measures, I think that should be a very great conducive environment for the next coming year for India. Thank you.
Thanks, Manish. I did note earlier that you did mention about the liquidity aspect as well, and connected to it was your comment on the vaccine deployment, and which is like looking up in different areas in India. But while we wait for Ashwin, I guess we just lost him for some technical issue. But I just had one more quick question. This liquidity perspective, and both of you can please try and chip in with quick answers, because you'll just be running into designated time. Do you think the availability of fairly low cost money, and typically what the world calls it carry trade, is that really triggering a lot of emerging market upside, in terms of the performance? Because I mean, from an investor point of view, is that triggering? Because that along with the fact that from a domestic investor's point of view, if I were to expose myself to international investments today, would my currency eat into my possible returns? I mean, any quick perspectives, and we have Ashwin back as well. Ashwin, if you heard my question, two things here. Is
Yes,
there
I
some
did. I'm sorry, I just had some tech.
problem? Some carry trade effect that's flowing in liquidity into emerging markets. That's one part of it, and the other part is, if you are an investor within such emerging markets, would looking outside of that market make sense if, in case the currency, kind of ends up eating into your returns that you might generate elsewhere? I mean, kind of connected, maybe disconnected, just throwing it out in the open.
So, do you want me to go first?
Yeah, please.
Okay. So basically, I think, see, currency is very important because it determines sentiment and flows. It's important because people look at it to decide near-term sentiment, etc. However, currency is not a big driver of the actual long-term equity performance from any market. So this is how we should look at these two things slightly differently. Look at currency more to see how the sentiment and near-term flows and near-term performance can be. But ultimately, when you're allocating to a market, don't allocate because of the currency part. Allocate because of the opportunities in that market, etc. And in that sense, I think they again because some of them have really come strong currency. Also, I think it's ultimately when you look at the attribution of equity returns, it is much more driven by underlying performance than currency. The other thing I'll also highlight is typically fund managers do adjust for currencies when they are making these kind of investments. So they are also able to manage some of these effects a little bit better. So ultimately, like I said, for investors, currency may help in terms of managing, navigating sentiment in the near term. But the long-term structural case has to be seen other than currency. It has to be seen more in terms of the pure growth prospects itself.
Any perspectives, either Manish, Ziyang, any one of you? So then we will have time to take at least a question from the audience.
Yeah, I think I'll just put a minute or so on this. And this is a very interesting question again. When you say that there is so much of liquidity, is that because you're seeing the valuations going just next level? Because effectively, the yields, whether you're talking about the debt yields, are available at 0%. So there is no logic people put it in a asset like debt, and that all money is moving into an equity asset class, and that's why the valuations is looking. That's a very solid point which we have. But I just wanted to put this in slightly in a bigger picture. If you look at post 2008, after 2000, the GFC crisis, we've been living in a condition where the interest rates are coming down. We are living in a condition where the liquidity conditions has been very, very ample. Just barring probably 2013, where we have seen a taper tantrum where Ben Bernanke came out and made a statement. Apart from that, we have been living in an environment where the interest rates are coming down, liquidity conditions is improving. So I think environment was there for equity market to continue performing and do well. But at this juncture, the major difference, which is actually giving us a more confidence that the emerging market and all can come back well, and the winners can be different this time. Why I'm saying the winners can be different, you have seen the tech companies doing extremely well for the last 10 years. So if you look at S&P 500, the big tech companies contribute almost 25% of the index, which is all-time high if you compare it with the 2000 dot-com bubble.
Yes,
but
true.
this time, I think the winners are going to be different because there is a stimulus measures which is going to come in. So liquidity is one condition which has created an environment, but going forward, I think the fiscal stimulus measures, the value stocks, where the earnings can come back and all, I feel that is something which is going to, the earnings story is what is going to play out well. So it would be more about expansion, PE expansion and all, rather than what we're seeing. So,
thanks, Manish.
Right.
Jan, anything from you?
Okay, I think Ashwin and Manish actually talked about a lot of very good points. So there's really not much for me to add. But just one last thing, say for example, for in terms of investing, for the I think for the rest of a lot of your global investors, they are looking at their portfolio in a more professional, more diversified way. It's all about relativity, right? So if a lot of your carry trade are definitely going to benefit for your EM markets, your India, your Latin America, your China markets are going to benefit from the carry trade simply because in the developed world, if you look at US and Europe, yes, longer term yields are starting to pick back up because of fears or more of like inflation expectations starting to pick up. But I think if you have listened to the kind of conversation or the speech that Powell has been talking about, is that inflation is not going to pick back up that substantially. In fact, we are looking at a global reflationary environment, and that inflation not picking up to sort of the Fed's yet has been there for the past. It's not just a 1 or 2 year thing. It has been around for the last 10 since the Great Financial Crisis, 2008. So your interest rates are not going to come. it's not going to pick back up very substantially within your developed market, which also means that when the world start to recover, a lot of your developed world market investors, these wealthier investors, are going to look into into your emerging market to look for growth opportunity, and that is where your domestic markets, if you are a be it you are India investor, you are ASEAN investor, you are China investor, you are South Korean investor, you're going to benefit from that kind of inwards flow from your foreign capital. Yeah,
Yes,
and I think
yes.
that's
That's great. So we have, I guess, a question from the audience. Could we have that on screen, please? Yeah. Okay, Zian, that's for you.
he actually in terms of heading into the start of this year, I think we are quite optimistic on India as an economy. We think that the valuations are a little bit frothy at this point of time, as well as there's a lot of idiosyncratic factor that is weighing down on India as a market. So we didn't actually express a very positive or a very optimistic view in relation to the rest of the world. But looking ahead, I think Manish actually talked about it just now, is that a lot of monetary policy help, fiscal stimulus is being pushed out to support your huge consumer market within India. And as soon as we start to see a lot of these early signs of reflation, a lot of your recovery in terms of economic growth in India starting to pick back up, we definitely have it on our watch list, and we'll look to upgrade it whenever we think that the signs are clear that India is going to be a very good risk reward kind of prospect. So at this point of time, you opt to stay a sort of a very or more neutral stage, or maybe a little bit underweight. But yeah, things are going to change as market conditions change.
Interesting. We probably can take one more question and then we will just have to wrap up. That will be the time that we have. I guess the one that is on my screen actually says, do we know funds that invest in markets like South Korea and China and US? Oh yeah, yeah. Are there any asset managers who invest in South Korean markets? Have we seen country-specific South Korean funds, Zian? Do we have something like that?
Okay, so I'm not sure whether I can take this question because it's going to be a little bit more specific to the India market itself. And I'm not that familiar with the fund selection that is on your platform. But I think across the world, even in Singapore, there's not a lot of markets that provide such specific geographical exposure. So but the thing is that South Korea, your China, your India are major components within your Asia, Japan kind of equity funds, which I believe on India platform should be that's definitely be on the platform. So if you want to express a more optimistic stance on these markets, go ahead and go with a more bigger approach in terms of your Asia ex Japan fund picks. But if you want to express more, say a more specific or more overweight position on South Korea, you can look at the big names. Your Samsung Electronics, your SK Hynix, a lot of your semicon or even your automotive makers, you can actually just purchase it either via maybe via single equity exposure through your US market, or to kind of add on to exposure to in terms of the whole entire portfolio. Yeah, but it depends on your platform. I would suggest the best bet right now probably would be Asia ex Japan.
Ashwin, you wanted to chip in something in between, so please.
Yeah. I hear that the Korean market, has obviously a few really good stocks, but the issue with any country market is whether you do a single country product. is you have to see whether you can make a well-rounded portfolio from that country. It has to be a big enough market. It has to offer a breadth of opportunities. And we are obviously a little spoiled here because the Indian market is so large and it is such a large breadth of opportunities. So when you're looking at markets outside India, there's just a handful of markets, probably only US and China, if I could name two, who are big enough, broad enough in terms of offering a breadth of opportunities. Otherwise, for instance, as Z already mentioned, it's much better off being into the broader strategies, whether it's the Asian, EM, or global strategies, because those fund managers are able to pick and choose the best ideas from each of these markets and play them out. Therefore, I feel that yes, there could be a few funds for every country in the world. I mean, people have a lot of funds out there, but from an investor's perspective, especially investors in India, I think broader is the way to go. Just we are very early in our global investing cycle. Don't try and find too many niche ideas at this stage. Just stay with the broader allocation products at this stage.
Thanks, Ashwin. I mean, been a quick fire for all of us. It's a Friday evening. I'm sure probably we are between a lot of participants and their Friday fun. So, without further ado, let me just take the opportunity to just thank Jiang, Manish, Ashwin. Very kind of you. I just went the reverse order. And I'll hand it over to Dipali. Dipali, over to you.
Thank you, Rajesh, and thank you all of you panelists for a very spirited conversation. I'm sure our audience enjoyed that a lot. Thank you so much for your time.
Great.
Thanks.
Thank you.
Now, moving on. Yesterday, we spoke about what you can invest in when our senior analysts presented our recommended global mutual funds. Today, we talk about how you must approach global investing from an asset allocation point of view. Here, with his insights on asset allocation and rebalancing in a global investing context, we have Yu Wei Ren, Manager, Stocks and ETFs Research with iFAST Financial Singapore. Welcome, Wei Ren.
Hi, Deepali. Thanks for having me.
Our pleasure.
Give me a minute while I just share my screen. Hi, good afternoon, everyone. Thank you so much for having me here today. By way of introduction, my name is Wei Ren. I am actually part of the research team over at iFAST Singapore. So the main topic of my sharing today is really on portfolio construction and asset allocation. How do we construct a portfolio that is adequately diversified across all the major markets around the world? So this is essentially the question that I will be addressing in my presentation today. But before I move on, I just want to say that there is no such thing as the best or the only way for investors to construct a portfolio. I believe there are actually many different ways that investors can use to construct a diversified portfolio. So what I am about to share today with everyone is really just one of the ways that you can consider for your clients and for your portfolios as well. And this is also a portfolio construction that we use for portfolio construction for our Singapore clients over here. So I will be sharing with you the framework that we are using, and I hope this is something that will be beneficial to everyone here today. So without further ado, I'll just like to jump straight into the investment process that we use. So this is essentially a 4-step process that we use over in Singapore. And our investment process really starts off with an inter-asset allocation, followed by an intra-asset allocation, product selection, and the last step in our portfolio construction process is really to do a periodic review and a rebalancing of our portfolios. So over the next few slides, I just want to go through each of these individual steps, what they involve, what are some of the things that you should be aware of. So the very first step is inter-asset allocation. when we start building a portfolio, the first question that we need to ask ourselves is, what asset classes do we want to invest in for this portfolio? And as you can see on this screen here, I've actually included two commonly used asset classes that are present in a lot of investment portfolios, equities and bonds. So for our Singapore clients, most of them, they invest in a mixture of equities and bonds. But there are also some investors who see gold as a separate asset class by itself. And there are also investors who see cash as an asset class by itself. And sometimes these investors, they want to put it inside their asset allocation. And that's perfectly fine. But for my presentation today, I will just be utilizing two commonly used asset classes, and that is equities and bonds. So after deciding what asset classes you want to invest in, the next question then is, how much do I want to put my portfolio into equities, and how much do I want to put inside bonds? So equities in general, it's riskier than bonds. So for our more conservative investors, we generally recommend them to have a bit more exposure to bond markets compared to equities. And also on the other end of the spectrum, for the younger investors, for the more aggressive investors, we generally recommend to have a bit more exposure into equity markets. And of course, for investors who are somewhere in the middle, we also have suggested allocations for the moderately conservative, balanced, as well as the moderately aggressive investors as well. So these allocations that you see on the screen here are suggested allocations that we recommend to our clients, and they are also what we call the neutral asset allocation. Neutral asset allocation meaning that if you do not have any strong views on the future performance of any asset class, if you're not sure if equities is going to do well or whether bonds is going to do well over the next 12 months, then this will always be the asset allocation that you fall back on at any one point in time. But of course, if you do have a strong market view that you want to incorporate into your inter-asset allocation, it is also possible. It is possible for you to make adjustments to your inter-asset allocation based on your market views. So for example, a balanced investor that runs a 50-50 equities and bonds allocation, supposedly this investor thinks that the equity valuations are very cheap right now, and he thinks very strongly that equities are going to do a lot better than bonds. So for this investor, what can he do? He can actually increase his allocation to equities. He can actually go overweight on equities. And if you can see on this screen over here, this balanced investor has actually increased his allocation of equities from the original 50% to the current 65%. And the same thing can also be done if this same investor feels that equity valuations are expensive. I think now is a very good example. I think some people are talking about a bubble in equity markets and whether now's the time to sell. And for investors who are very fearful of a short-term market pullback, what they can do in their portfolios is to perhaps to go underweight equities. And going underweight equities means that they reduce their allocation, or rather they reduce their exposure to the equity markets inside their portfolios. And again, back to the balanced investor, okay, from an original 50%, this investor has actually reduced his equity allocation down to 35%. Now, at this point, even though I say that investors, they can make adjustments to their inter-asset allocation based on their market views, something that we always remind our clients and our investors is that they should not always make big adjustments to their inter-asset allocation for two reasons. The first one is, of course, market views can be wrong. Just because you are positive on the future outlook of equities, it doesn't always mean that equity markets will definitely do well. And you can be wrong. So to mitigate this risk of your investment views getting wrong, we generally don't recommend clients to make big changes inside their overall portfolio allocation. The second reason is by making big changes in your allocations, the overall risk profile of your portfolio is going to deviate very substantially from the original, or rather the intended risk profile of the end client. And this is very important because a balanced portfolio, an investor that originally runs a balanced portfolio, if he suddenly decides to sell all his bonds because he thinks equities are going to outperform bonds over the next 12 months, he ends up becoming an aggressive investor. And if markets do have a short-term pullback, this end investor, he may not be able to withstand the short-term market volatility. And that's when he will be fearful and may contemplate on liquidating all his assets. So we recommend that investors, they do not make big changes. How much of a change? The guideline that we tell them is usually, I think, a plus minus 15% from the neutral allocation is something that we always recommend. So, for example, the neutral allocation for balanced is 50-50. So the maximum amount of equity exposure for this balanced investor is actually 65. Try not to go any more than 65. And similarly, for the moderately conservative investor, the maximum amount of equity exposure is 45%. And this investor should not try to go above that. If not, his portfolio will start to deviate. The risk profile will start to deviate from the original intended risk profile. So this is step one, inter-asset allocation. You decide what asset classes you want to invest in and in what proportions to invest in. And that also brings me to step two, which is intra-asset allocation. So at this stage, essentially what you're trying to do is you want to decide what geographical markets you want to invest in. Within bonds, what bond markets do I want to invest in? And within stocks, what stock markets do I want to invest in? So for us, we do our bond and stocks allocation quite differently. And I'd like to share with everyone first how we do our bond market allocation. And for iFAST research in Singapore, we try to be invested in major bond markets around the world. So this may not be applicable to an investor who is based in India and may not suit the investment landscape in Singapore, in India, because for Singapore, our platform, we do have access to global bond markets. So we are able to be invested in major bond markets. And if you look at our suggested bond market allocation for investors who are based in Singapore, we usually recommend them to do a credit barbell, a 65-35 credit barbell, 65% allocation to investment grade, 35 to high yield. So it's a good mixture of the safer credit risk segments, as well as a fair bit of exposure to the higher yielding segments that can give you a higher rate of yield especially for investors who are seeking a higher level of income. So very diversified, and also we feel that the fixed income should have larger allocation to the safer bond segments because fixed income traditionally has always been a portfolio stabilizer. When equity markets don't do well, you actually expect fixed income, your bonds to actually help you to cushion some of your portfolio losses. So we try not to take too much risk with our bond market allocation. And this is the suggested allocation that we provide to our investors here in Singapore. And for equity markets, the way we do our equity market allocation, it is based on a GDP weighted methodology. And what do I mean by that? It essentially means that the amount of allocation that we give to all the different equity markets out there is based on the size of the underlying economy. So a very quick example, the US equity market, for example, the GDP of the US market as a percentage of global GDP, that's about 21.5%. So in our overall equity market allocation, we give it an allocation of 21.5%. And also we ensure that our investors are invested in a lot of the key markets out there, which includes Asia ex-Japan, Europe, Japan, and we also have exposure to Latin America and EMEA as well. So this is a market allocation framework that we generally recommend to our investors, and it is not static across time, meaning that we always try to revise this market allocation based on the current economic realities and also the current investment landscape. So one of the recent changes that we have actually done to our equity market allocation is we have actually added an allocation to the digital economy. So digital economy is essentially stocks that are related to technology, as well as the internet. And we have got a lot of questions from investors why we want to do this, because generally the investor mindset towards the digital economy stocks is that, oh, it's very volatile, it's very high risk. Why do you want to put it inside your equity market allocation? So our explanation to our investors is that we believe that the digital technologies it has been an increasingly important part of our global economy. Before COVID-19, the global economy has already been increasingly digitalized. But now we have COVID-19, and we can see from in across the world, technology adoption across the world has been accelerating, not just within the business arena. For businesses, it is no longer a luxury for them to be online. It is in fact now a necessity for them to have an online presence in order to reach their consumers. So not just for businesses, consumers as well. Consumers like you and I, our lives are also increasingly digitalized by technologies. And also, if you look at the size of the digital economy, it is actually so big that it can no longer be ignored. Because if you look at it as if it were a national economy, then the digital economy is actually the third largest economy in the world right now, just behind the US and China. So it is because of these reasons, because of the fact that we think digital economy, it is going to be an important part of the global economy, which is why we feel that the digital economy should be considered a core part of your equity market allocation. And for that, we have actually assigned a 10% allocation to the digital economy. 10% because, again, back to our GDP weighted methodology, the size of the digital economy as a percentage of global GDP, it's about 10%. So we have a 10% exposure to digital economy stocks within our equity market allocation. And of course, along the way, we will have certain tactical ideas, sector ideas that we implement inside our portfolios for our clients. These tactical ideas, they tend to be a bit higher risk. They tend to be very niche investment ideas. As you can see from some of the tactical ideas that we currently have inside our managed portfolios in Singapore, we have exposure to financials, semiconductors, and we have also China internet exposure inside our managed portfolios. So generally, these ideas, they deliver higher alpha, but at the same time, they also come with higher risk. So for us, we tend to limit it to a maximum of 20% of equity allocation for tactical ideas. Now, what does this mean for you? It also means that for yourself or for your clients, if they have some very high risk investment ideas that they want to buy into, Bitcoin, if they want to buy into GameStop, silver, some of the hottest investment trends in the market right now. Sometimes you can't stop them. You can't advise them against from investing in speculative products. If you can't stop them, then the advice that you can give to them is that, maybe you should limit 20% or maybe even a smaller percentage of your portfolio into these high risk tactical ideas. So this is one way for you to advise your clients. But for us at iFAST Research, we of course do not invest in speculative investments. We do invest in sector ideas, and these investments are generally limited to a maximum of 20% of our equity allocation. Now, after deciding the asset classes and also the markets that you want to invest in, the next step then is to go into product selection. And there are actually a variety of products that you can select to gain exposure to all the different markets that you have identified in the previous step. So you have the more diversified investment vehicles like your mutual funds, ETFs, and you can also consider using individual securities like stocks and bonds as well. But for the purposes of my sharing today, I will just be focusing on the more diversified investment vehicles, which is mutual funds and ETFs. How do you select mutual funds and ETFs for a portfolio? So mutual funds and ETFs, they are two very different investment products altogether. So for mutual funds, you try to find the portfolio manager which has a very strong track record of outperforming the markets. So generally, we tell clients that if you want to choose the right mutual fund, generally you should look at these three criteria. performance, expense, and the resiliency. They always say that performance is not always necessarily indicative of future returns, but in the case of mutual funds, in the case of active strategies, we think that performance is a very important indicator of the track record of a fund manager. It is an important indicator of whether this fund manager has what it takes to outperform the market. So performance is very important, and not only do you look at the cumulative returns of a mutual fund, you also look at the calendar year returns of the mutual fund to assess its consistency. Expense, I think quite straightforward. Expense, the lower it is, the better it is for investors. So that is also part of our consideration. And I think resiliency, that's another part of our consideration as well. We want to see how well these funds hold up during periods of market correction. So for that, we generally look at the maximum drawdowns of the fund and also the downside volatility of these mutual funds. ETFs, on the other hand, they are passive vehicles. They are not designed to outperform a certain benchmark. In fact, they are designed to replicate the returns of an underlying benchmark, which also means that when you select ETFs, you shouldn't be looking at its performance, whether it can outperform an index, because it is not designed to outperform. For ETFs, essentially, you want to select the ETFs that gives you a return that is closest to the index at the lowest cost. So for that, again, we look at the expense ratio of ETFs. The lowest ETFs, it will definitely rank favorably against its peers. Tracking difference, that's another consideration because you essentially want to pick the ETF that gives you the returns that is closest to its underlying index. And because ETFs are exchange traded, liquidity comes into the picture because you essentially want to be investing in an ETF that has high liquidity because it allows you to react very swiftly to changing market conditions. You don't want to be in a situation whereby you want to get out of a position in an ETF, but you realize that you're holding onto an illiquid ETF, and which also means you can't actually sell it off as quickly as you would have liked to. So liquidity, again, I think that's another important consideration selecting ETFs. And commonly asked questions by advisors and investors in general is, which one should I be choosing? Should I be choosing active strategies? Should I be choosing passive strategies for my portfolios? And my answer to them is always this: why choose one when you can have the benefits of both? And I say that because it is my personal belief that there is currently no one single investment product out there in the market right now that can do everything for our portfolios. So I think there are certain markets whereby it will make sense to go active because in certain markets, the active managers, they are able to deliver alpha relative to their underlying benchmarks, especially in emerging markets. I think that is where active managers, they can add a lot of value to investors. So for this kind of markets, I think going active, it's the right way to go. And for markets whereby you find it difficult to, in markets whereby it is difficult for active managers to outperform the market, I think this is a scenario that is especially true in developed markets. I think passive strategies will come into the picture. So depending on the market you're looking at, sometimes you might want to go active, sometimes you might want to go passive. It doesn't mean you have to construct a portfolio that is purely active or purely passive. I think the way to go forward, the way to run a successful portfolio is to have a good mixture of both active and passive strategies. And the last step in this portfolio construction process is to do a regular review and a rebalancing of the portfolios. So what do you review? You review your portfolio positioning to see whether it reflects your market views. If you want to make changes to your inter-asset allocation, like I said just now, if you think equities are going to do well, then of course you can go overweight equities relative to bonds. And on top of that, you also want to monitor your portfolio allocations to ensure that they do not drift substantially from their intended targets. Because if they do, then this is actually a sign for you to do a rebalancing for your portfolios. So at what stage do we do we do a rebalancing for our portfolios? I think this is a question that I receive quite a lot from investors. I think there is no hard and fast rule. For us at the Singapore team, we always go back to our neutral asset allocation, which is the very first step that I talked about. We look at our portfolios and we see what is the current inter-asset allocation right now. So again, back to the balanced portfolio example, initially it's 50-50, but as markets move up and down, this percentage could be, 45 bonds, 45 and 55 equities. So the moment it starts drifting substantially from the original target, I think this will be a signal for us to do a rebalancing. How much is too much? That's also another question. I think again, no hard and fast rule, but generally we don't do 5% because if you look at the aggressive portfolio, for example, for the drift to become 5%, you actually need equity markets to sell off by 40%. Do you actually want to wait for equity markets to drop by 40% before you do a rebalancing for your clients? For us, we don't think that's an ideal situation. We think that a 20% decline in equity markets, I think that's already a sharp enough drop for us to want to do a rebalancing. So generally, I think the rule of thumb that our team follows, I think anywhere between a 2 to 3% drift from the original target, I think this will be a good time for you to consider doing a rebalancing for your portfolios as well as your clients' portfolios.
Hi, Viren. Sorry to interrupt. We have a couple of questions from the audience. Since you have finished your PPT once, would you be okay to take the questions, please?
Oh, yes, sure.
Sure.
Okay. I'm okay. Digital economy may see rise of newer companies outside of the US. How do you propose to allocate the funds geographically? Okay. For us, we generally use an ETF to get exposure to the digital economy. We do not do individual stocks because we don't want to run company-specific risk inside our portfolio. So generally, we do ETFs, and the ETFs that we use, generally they have an allocation of about 60% US. Okay, I think first and foremost, the key markets in the tech space right now, I think US, China, Korea, and to a lesser extent, I think in Latin America, I think these are some of the commonly used markets by some of these ETFs and active strategies. So I think a 60% allocation to the US, which is currently the forerunner, the front runner in the tech space right now. I think that is something that I would suggest it is, again, not a hard and fast rule. For China, I think it could range somewhere between 10 to 20%. And that actually means that your entire portfolio is going to be skewed towards the two largest markets for digital economies. So US and China, and the rest, I think it will be into other emerging markets like Latin America, South Korea, and also India as well. I think India is also a market that I personally am very excited about, especially in the tech space. I think there are a lot of companies that are investing in India's tech space right now. So I think this will be my suggested allocations for the digital economy. Books on asset allocation. The asset allocation framework that I shared with everyone just now isn't actually something that can be found in books. But if you want, I am a value investor at heart. So if you want me to recommend books, the first book that I generally recommend to everyone is The Intelligent Investor. That was the first book that I read when I started on my investment journey. And I think everyone who wants to invest in the market should have a read, should have a look at this book. If not, then maybe security analysis, that will be another recommendation that I have off my head right now. But specific to asset allocation, unfortunately, I don't have any recommendations at this moment. Can global investing be pursued only through ETFs? Yes, if you want to run a 100% ETF portfolio, it is entirely possible. If you go to the US exchange, just purely the US exchange, you can actually find a lot of different kinds of ETFs, even China ETFs, India ETFs. Some of them are listed on the US exchange as well. So yes, you can construct a globally diversified portfolio using ETFs. But having said that, I refer everyone to my slide just now. I think a successful portfolio should be run based on a right mixture of both active and passive strategies.
Thank you so much, Varen. That was very, very insightful. I hope, ladies and gentlemen, you were paying close attention to Varen's talk, because our second poll question for the day quizzes you just on the same topic. Okay, our next session talks about a developed market that has seen its fair share of interest recently. Especially investors who want to rationalize their investment in the US markets due to its valuations have been looking at Europe to try and gain from its upcycle. Nick Wilcox, Executive Director of JP Morgan Asset Management International Equity Group, spoke to the iFAST Singapore team to offer his insight and outlook for the Europe market for 2021. The JP Morgan Europe Dynamic Fund is the mother fund of the Edelweiss Europe Dynamic Equity Offshore Fund, which is part of our recommended list. We're very happy to have Nick Wilcox join us via this recorded interview. Nick Wilcox, ladies and gentlemen.
Europe is suffering the second wave of infections and lockdowns. What is the recovery outlook?
Yes, Europe, like much of the world, is suffering from a second wave, and actually in a number of countries, a third wave. The good news is that things are recovering, albeit quite slowly. I think what we need to remember, though, is where Europe was before the pandemic. And of all the regions in the world, Europe is most exposed to global growth. And that is to say that if the world is expanding, Europe is benefiting. And if the world is contracting, Europe is obviously in a more challenging place. So with that framework in mind, Europe, of all the regions in the world, was one of the most badly impacted by the pandemic over the course of last year. But what that means is that as the world recovers, Europe stands to benefit far better than many of the other regions of the world. So in that regard, we are quite happy with the outlook for the region. If we put that into numbers that we look at in our everyday investing lives and look at earnings growth, we are forecasting very, very strong earnings growth recovery from Europe over the course of this year, more likely towards the second half of this year. But importantly, that continues into next year as well. So overall, the outlook is looking very strong. Equally, like many other governments around the world, we saw the European Central Bank deploy huge amounts of stimulus into the market to support companies and households through the pandemic. Something in the region of 4.5 trillion euros of stimulus has been put into the market over the last year. Now, this in itself is obviously very good. A lot of those initiatives are actually focused towards climate change and renewables, and again, that should be very supportive moving forwards. But what I think a lot of people have missed is that this is almost the first time that we have seen a truly collective response from Europe. So we have this whole concept now of a far more integrated Europe. And I think longer term, that is going to be very powerful for the region and is another thing that we're looking at very positively in terms of the outlook. So to answer your question in short, yes, Europe is still experiencing second and third waves of the pandemic, but actually the outlook from here as the world normalizes is very positive.
How do you allocate your portfolio? Is there any country bias, and what determines the allocation to a particular country?
So the European Union today is made up of 27 different countries. Each or many of those countries have different languages, different tax policies, different politics, a real mix of variety on a number of levels. So historically, it has actually been very, very difficult to predict or to forecast which of Europe's countries stand to do best in a given calendar year. From our side, what we try and do is use our combined quantitative and fundamental investment process to not look at individual countries, but instead to look at individual companies and predict which of those companies are likely to prosper into the future. We are helped in that way by the fact that our strategy is unconstrained. And what that means is that if we don't find any interesting or attractive opportunities in a certain country, we don't have to own them just because it happens to be in the benchmark. Similarly, if we find lots of great opportunities in a certain country, we can own all of those without any concern about the structure of the portfolio. So that whole idea of just having best ideas in the portfolio is very, very helpful to us. If I think about where that investment process and bottom-up stock-specific approach gets us today, we are very overweight towards Germany. We find a lot of really interesting stocks there in the capital goods space, retail, auto companies. On the other side of the equation, we are quite underweight towards the UK. That is not to say we don't find opportunities there. There are a lot, but they're typically towards the smaller company end of the spectrum. So we're actually underweight, or we don't own many of the big, large cap, expensive, defensive companies, which leads to that underweight. So again, in summary, try not to think of Europe as a mixture of different countries. Think of it as a large pool of really interesting companies and try and pick the very best of those rather than trying to forecast which particular country might or might not do best next year.
What is the impact of Brexit on European equities?
So Brexit has been a huge overhang of uncertainty for Europe for the last 4 years. And whilst we expect there is more negotiation to come, clearly the deal that was struck recently lifts a lot of that uncertainty away. And we now have a much clearer path for how Europe and the UK will interact into the future. And that in itself is obviously a positive. Now, what has been very interesting is that that level of uncertainty has essentially created a large discount when it comes to valuations in Europe. And I say Europe because Brexit wasn't just specific to the UK, it impacted the whole region. So at the moment, what Brexit has done, or what the Brexit deal has done, has removed a lot of that uncertainty, but markets are still quite slow to react to that. So we're still finding a lot of very attractively valued companies in both the UK and Europe. Now, if I think about the world at the moment, most things look quite expensive, but we need to think about how things look relative to each other. And equities themselves look quite attractively valued relative to, say, fixed income. Europe looks attractively valued relative to the rest of the world. So today, if I look at, say, the dividend yield of companies in Europe, they are trading at around 3.1%. That is in line with the long-term average, but it's a meaningful uplift on what you can find in the fixed income world. So the removal or the clearing up of the Brexit situation is a positive for Europe as a whole. It has created, over the last few years, a big discount. That discount will slowly be removed as investors get more comfortable about the path ahead.
What are your favorite sectors and why?
So if we think back to the earlier question about countries, it's a very similar situation when it comes to sectors in Europe. We prefer not to try and predict which sectors are going to win or lose. We prefer instead to look at it from the bottom up, from a company-specific perspective. And I'll give you an example of that. If you take the retail sector, for example, it is a mix of many, many different companies that have been impacted in very different ways by the pandemic. And actually, those companies stand to have very different outlooks on the way ahead. So if you think about your traditional bricks and mortar high street stores, they've obviously had a hugely challenging period over the recent year as people have been forced to stay in and around their own homes. If we think then to companies that are more exposed to e-commerce, clearly it's the opposite scenario. People still want to consume. If they can't consume in a real high street store, they will start to move to an online alternative. So we've seen a huge acceleration in the number of people using online retail. We believe that shift is not just a one-off from the pandemic. We believe that continues into the future. So you've got two sets of companies here within just one sector, some of whom have been incredibly challenged and potentially will struggle to recover from that once the pandemic passes. And then on the other hand, you've got those companies that have been the real beneficiaries of that shift to e-commerce. So rather than just buying sectors where you're going to get a huge mix of companies, we prefer to target in, focus in on the companies themselves. What that actually means is that we can get much more variety in our portfolio. And again, coming back to that whole idea of just holding the very best ideas in the region. What actually excites us at the moment, and this comes back to a point I was just making on valuation, is that the valuation spread, so the difference between the most expensive and least expensive stocks in a given sector, is still very, very wide, at really, really extreme levels. And what that means for us as active managers is that there's a huge opportunity set ahead of us to add even more value than we typically do. So it's a great time to be investing in actively managed portfolios. Thinking about the portfolio itself from a sector perspective, perhaps no surprises here. The sectors that we really like, where we find a lot of interest at the moment, are semiconductors. We like capital goods companies. We like transportation companies. All of the areas that are likely to be the big beneficiaries of the pandemic gradually moving to one side and the world normalizing once again. So similar story to countries. Let's try not to just pick specific sectors. Let's just try and pick the very best companies that we find in front of us.
Compared to US and Asian markets, Europe has not gotten as much attention from investors during recent times. Could you share what are the opportunities for Europe now?
Yes, of course. You're absolutely right. Europe has not received the attention that we've seen in the US and Asia. And in fact, returns in Europe have also been significantly lower than we have seen elsewhere. If we think about that and what that means, Europe's share of the value of the global equities space has almost halved over the last couple of decades. So Europe used to be about 30% by value of the global universe. Today, it's closer to 17%. And a lot of that is to do with what you were actually buying when you bought into a European equity strategy. What sectors were you most exposed to? what sectors were you least exposed to? So if we think back 20 years, the big overweights from a sector perspective in Europe were to banks and to energy. Two sectors that have had a very, very challenging time over that period, and in fact have delivered little to no earnings growth through that time. If we think about the other side of the equation, what sectors were you underweight or underexposed to if you bought into Europe? It was all of those technology-related names in sort of software and services, companies and sectors that have seen huge increases in their earnings ability over like 20 years. So that is really why Europe has struggled over that time period, and that is why investors' attention has drifted elsewhere. The great thing about markets, though, is that they are essentially self-correcting. So by virtue of how those companies and how those sectors have performed, we have actually seen a real rebalance in the way in which the European equity market is positioned. So today, banks and energy and some of those staler manufacturing and sort of tobacco companies that Europe was so well known for are a much less sizable part of the index, instead replaced by some much more exciting and innovative companies that have increased in importance over that time. If I think about what excites us about Europe moving forwards, it's no longer that sort of traditional manufacturing and finance exposure. Today, it's more about things like health tech, med tech, clean tech, all of these sort of buzzwords that we're all thinking about. Europe is actually home to a great number of companies that are leading the way in those spaces. If we take, for example, renewables, 8 out of the top 10 companies in the world that were exposed to renewable energy last year are actually European. So Europe today is home to some really fascinating opportunities. And again, coming back to those earlier points, many of those opportunities still come at a good discount to the rest of the world. The other area that interests us about Europe is, again, related to technology. If we think about the big drivers of returns in the US and Asia in recent years, they've typically been consumer-facing technology stocks. And you will rightly be thinking that Europe is not home to many of these big consumer names. However, what is interesting and what we've seen in the news in recent months is that a lot of these big consumer technology companies are coming under far, far greater regulatory attention. And that in itself is quite interesting. That regulatory pressure, that regulatory attention is very unlikely to reduce from here. And typically, increased regulation leads to reduced profitability. We still think a lot of these names in the US and Asia are very interesting. We still think they have a lot of success ahead of them, but that success may well be somewhat diluted by that increased regulation. In Europe, firstly, we don't have those companies. And secondly, when it comes to regulation, we have been working under heightened levels of regulation in Europe for many, many years. Our companies are used to it. It's very, very unlikely to increase from here. And as such, on a relative basis, actually Europe stands to do very, very well. So bringing all that together and really answering that question about the outlook for Europe in a slightly shorter fashion, we are excited. Buying Europe today is very different to buying Europe 20 years ago in terms of the exposure that you get. There are still companies in Europe that have problems. There are still countries and sectors in Europe that have problems. But actually, if you take an unconstrained and stock-specific approach, you can avoid many of those issues and focus in just on the best ideas. And finally, because of all of the political noise that's been in the background for Europe over the last 5 years or so, many of those opportunities come to us at a very attractive discount to the rest of the world.
Thank you, Nick Wilcox and the iFAST Singapore team for helping us do this. Now, Japan is another developed market that is being watched closely for its unique strengths. It is home to SoftBank as well as other new age sectors like semiconductors and robotics. Takamizu Hara, Senior Vice President, Nippon Life India Asset Management, joins our Managing Director, Eric Horn, in a video call to offer his outlook for Japan for 2021. We'd like to thank the Nippon Life India Asset Management team for helping us gain access to Hara-san. Let's view his...
Hara-san, thank you very much for joining us in this first global investment conference in India. Right, as you know, Japan is also a key market in the world, and global investing is actually something that is very new to the Indian investor today. Right, so we want to take this opportunity to actually understand the Japanese market and also your fund, your strategy to actually take care of the risk and the opportunity of the market. Right. So my first question for you will be, what are the key drivers of the Japanese economy and the equity market?
Yeah, first of all, thank you so much, Eric-san, to have the opportunity to join the conference. In terms of your questions, at first, in terms of the Japanese economy, I have two key points. The first point is fiscal stimulus package. Compared to other countries, Japanese government already done a huge package in terms of the fiscal stimulus. I mean that already around 10% of GDP. And going forward, I think still a little bit more package will come later. So that should be quite positive for Japanese economy. And also, second point is global economic growth. That should be quite important for Japanese economy through that growth of trade, not only that economic growth in US, but also Greater China's economic growth is quite important for Japan nowadays. And in terms of the equity market, I also have 2 points. First point is net inflow by global investors. Nowadays, the global investors have about 60 or 70% market share in terms of the transaction. So going forward, that kind of inflow is still quite important. And also, BOJ, Japanese Central Bank, have been purchasing ETF as a monetary policy. So net inflow condition is there, already there. So adding to that, global inflow should be quite positive for Japanese market going forward. And also, second point is gradual depreciation of Japanese yen should be also quite important for not only for supporting Japanese companies' export, but also quite important for that Japanese equity market for all global investors.
That's really, really interesting there. Right. And currently the Nikkei 225 is past the 30,000 mark. All right. That is something that is a milestone since the 1990. Right. And we have an amazing run up in the equity market in Japan. So do you think there's actually a bubble right now and the momentum is a sustainable one?
Yeah, I believe that should be quite sustainable because based on the expected PL, it's now just around 22 or 23 times. It's a little bit expensive compared to historical average, which is around 70 times. But compared to US market or other Asian market, 22 times PL should be reasonable considering that quite low interest rate conditions. And going forward, that EPS should grow next several years in accordance with that economic growth in the Greater China as well as US economy. So I think that should be sustainable if there is no the downside risk like huge drop of global economic growth or huge appreciation of Japanese yen.
So I think you kind of answer some of my next question, which is what are the main risks that you see in investing in the Japanese market right now?
Yeah,
Right.
I think that main risk is the Japanese yen appreciation as well as the outflow by global investors. So in that sense, I think that the main risk is kind of a change of Japanese administration, Prime Minister Suga's administration, as well as the huge drop of that approval rate for that Japanese administration, because that kind of movement will lead to that yen appreciation or outflow by investors.
And given this environment right now, where we are seeing a relatively, like you say, high valuation, but of course it's lower when we compare to the US valuation, right? What will be your fund strategy actually in the next 3 to 5 years, given the valuation today?
Yeah, in terms of that macro investment perspective, we are the cautiously optimistic in accordance with that the gradual recovery from the COVID-19 conditions, while that the mutual fund investment strategy is totally based on the bottom-up approach, based on that each company's the growth and the profitabilities, and we are quite carefully taking care of that risk management based on the each the style factor or the beta, like kind of that. So I mean that bottom-up approach is quite important going forward.
And what are your favorite sectors and why?
Yeah, we have basically 3 favorite sectors. At first, the machinery sectors related to the factory automation. That should be quite important, especially in that Greater China area. The second sector is tertiary or that pharmaceutical sectors. I mean that which is closely related to the environment, new regulation, or ESG factors. So such kind of new momentum will be affected by the affected for the consumer staple names, not only by that good support from that consumer, but also quite important for that investors in that relatively moderate growth consumer staple segment. And the last segment, last sector is IT service sector, because of that digitalization and savvier and BPO, the business process or outsourcing, because in Japan, compared to US or Europe, that IT service segment is a little bit low base, and also Prime Minister Suga now pretty much focusing on that DX or digitalization. That is why investors are quite focusing on that segment, and the low base should be quite supportive for that going forward.
Right. And looking at the pandemic right now, how fast do you think the economy will recover?
Sure. I think that should be quite gradual. I mean that the second half 2021, that Japanese economic growth will realize quite gradually, because of that little bit slow vaccination compared to US or Europe, but also the new case in the COVID-19 is quite slow in Japan. So totally, I mean that situation is quite gradual going forward.
Right. My last question for you would be, do you see the structural trend of companies that's using capital more effectively through the higher dividend or M&As and buybacks to create shareholder value? Will that continue? And how important is this in the Japanese market?
Yeah, I think this question is quite important for Japanese companies because, as you know, Japanese companies' ROE is much lower than US companies, and also still lower than Asian companies as well as European countries companies. So, to improve ROE going forward, Japanese SFA and the Japanese Securities Exchange launched revised corporate governance code in 2018, and maybe next year they will again launch a revised corporate governance code, which will contribute pretty much to improve ROE going forward. And each company try to set a new policy for that their capital expenditures, including the dividend and the buyback and the M&A strategy going forward. And also not only that capital policy, but also they are trying to catching up that try to improve their profitability. That I mean that try to integrate into that US or Greater China's supply chains going forward. So that should improve their ROE going forward, and that should be quite supportive for Japanese equity market.
Right. Really very interesting outlook and ideas from you. And thank you very much, Hara-san. We really enjoyed your session with us, and it has been really very eye-opening for us. Thank you very much.
Thank you, Eric-san. Okay. Thank you so much.
Thank you, Eric. Thank you, Hara-san. That was very interesting indeed. Can we have the results of the second poll on screen, please? Wow. Okay. That's great. And it's very interesting actually, because if we consider in the past year, we've all become more aware than ever of, things like uncertainty, volatility, and risk, especially when it concerns our finances. Now, events like the coronavirus pandemic are known as black swan events, completely unpredictable and with potentially severe consequences. But is there anything we can do to protect our portfolios from the next black swan event? Sean Teo, Senior Research Analyst with iFAST Financial Singapore, is here with some answers. Welcome, Sean.
I'll begin sharing my screen now. Thank you for having me, everyone. My name is Sean. I'm from the iFAST Unit Trust Research team in Singapore. And today I'll be sharing with you some ideas as to how you may actually prepare your portfolios for the next black swan events. So the thing about black swan events is that actually it's a term that came from the past, right? Because people were less educated, and I think the Europeans were the ones who realized that, hey, I think it's pretty much impossible to find a black swan because it's something that they've never seen. But little did they know that, actually black swans are very they can be found very readily in Australia, right? So I think the whole idea of the black swan event, the idea of it is that it was came up with by Nassim Taleb. He's an author. He basically theorized that black swan events are basically financial market events that happen very infrequently, but they are often the catalyst for severe losses in market. So I think over the last few decades, we have gone through quite a fair bit of black swan events. And before we actually go through the list, of course, black swan events are something that we cannot actually predict, because if we did predict it, then it would not have happened. So some of the examples of black swan events that have occurred over the last few decades, over the last 4 decades. Of course, this list is not all encompassing, but I guess it gives you an idea of what black swan events are. So all the way from 1973, we had the Israeli and Arabian war. And also, I think we had SARS as well in 2003. We also considered it as a black swan event. and the GFC. Some people may have claimed to see it coming, but as a whole, the world did not see it coming. And last but not least, I think the most recent one is the COVID-19. So I think the biggest thing that I think you can observe is that there's no rule of thumb when it comes to black swan events, right? In terms of sell-off, they differ very wildly. In terms of the duration, they also differ quite wildly. The GFC lasted about an entire year, but in terms of sell-off, but I think when you look at just the COVID-19, I think just within a month, we recovered pretty much. We basically had the trough in financial markets just 1 month later. So black swan events, they have there's no real characteristics to them except that they are very damaging in terms of financial impact. So I would like to share with you some ideas as to how you can survive a black swan event. And of course, these are things that you may already know, but I think they cannot be emphasized any further because I think people at times do take it for granted in terms of looking at these things. And I'll show you how just by themselves they can actually diversify and improve your portfolio from a risk-adjusted perspective. But I think the really key point I will make at the end of my presentation is really that these 3 keys really help you psychologically, help your clients psychologically when investing in the markets long term. So the first thing as to why you should really think about preparing yourself for the next black swan event, aside from the financial impact, but really I think from a portfolio perspective, the odds are always against the investor, right? And I would argue that actually avoiding drawdowns is actually more important than chasing returns, because of the fact that your portfolio has to work harder for every dollar it loses. So this chart I think shows this idea very clearly. So on your x-axis you have your loss of the loss of capital, and on your y-axis is basically how much you have to gain for every loss of capital that you have. So for example, if you lost 25% of your capital, you would need to generate a return of 33.3%. So the more you lose, the odds continue to stack more against you. So when it comes to diversification, I believe some of the presenters earlier, they have already shared with you some of these ideas when it comes to inter-asset allocation, intra-asset allocation. Of course, just to recap, inter-asset allocation is basically diversification across asset classes. Equity, fixed income, alternative investments, gold, these are what I would consider inter-asset allocation. On the other hand, intra-asset allocation are basically within the equity segment, within the fixed income segment. How else can I further diversify my portfolio? And that's where your equity segments come to play, fixed income segments come to play, your geography comes into play. And I think from a portfolio perspective, the reason why you want to diversify is because most of us would definitely be invested in equities, and they are the key source of portfolio risk for us. So the idea is to actually, from an inter-asset allocation perspective, intra-asset allocation perspective, to pick investments that have the least correlation to equity risk. So what would it be like to be investing out of Indian equity markets in terms of like diversification, right? So this is basically a table stating over the last 10 years what the various correlation the Sensex index has with other global equity markets like your S&P 500, your Nasdaq 100, or your stocks, your European 600 index. And what we have found is that actually global equities move very differently from Indian equities. So by investing in global equities, by having some portion of a portfolio in global equities, right, you immediately get diversification benefits as seen from all these numbers, all these very low correlation numbers over here. So on a monthly, whether or not you compare it on a monthly return basis, quarterly return basis, semi-annual return basis, or even annual return basis, what we find that is that these global equities generally have a low correlation with Indian equities. And of course, this is from a rupee perspective. So by actually considering investing in global equities, it actually adds to your overall portfolio resiliency, because when Indian markets go down, it's unlikely that global equities as a whole would go down in the same magnitude as Indian equities. And I think another key reason I think to actually invest in global equities is because just to give you another perspective of what sort of diversification they offer. So over here, this chart over here, basically I charted all the unique Indian funds on the FSM platform, how they react to the Sensex index and how they react to, of course, your Indian 10-year government bonds. And what we realized that actually all your overseas fund of funds that's actually on the platform, which basically they invest in global equities, they have very low correlation again with the Indian equity market. And I think the key point to actually take away is that they don't just offer diversification, but they also offer you a new avenue for very profitable opportunities. And you just think about what the best equity market returns were in 2020, and I think some indices would be at the top of the list, such as your Nasdaq 100 index or even your Chinese equity markets. These are some of the markets that have done really well. And I think if you had invested in these markets, you would not have only profited, but you will also have increased the level of diversification for your portfolio. And of course, there are many ways to actually think about diversification. One way we like to look at it is always through a football field diagram, right? I think it's a great way to start conversations. So how you can do it is to really structure your portfolio from a football manager perspective. For your attackers, for your midfielders, you want assets that have moderate to high correlation with global equity markets, because these are the players that will actually score you goals. Whereas on the other hand, for your defenders, for your goalkeeper, you definitely want something that's more defensive, something that's more lowly or negatively correlated with global equity markets. And of course, if you combine everything together, you should get a very diversified portfolio. And another thing is actually portfolio rebalancing. So if the idea is really to periodically sell winners and buy losers, right? And I think this is a concept that many of you should already know. So this is to ensure that portfolio risk does not veer too far away from your investor's preference. And at the end of the day, portfolio rebalancing has shown to actually demonstrate better risk-adjusted returns. And I'll show you in the two case studies. The first one is the US equities and bonds. Let's look at overseas for the beginning. So what we realized is that when you rebalance your portfolio, it ensures that actually your overall returns are actually better off in terms of risk-adjusted terms. I say risk-adjusted terms is because actually on an absolute return basis, your returns would be lower. But if you account for volatility, then of course you'll be better off. It means that your portfolio is more efficient in terms of generating returns. So the other case study we look at is perhaps Indian equities and US equities. So this is what the results would have been if you had not rebalanced your portfolio. So a 50-50 allocation to Indian equities as well as US equities would have garnered you about close to 350% since investing in 1979, and this is in rupee terms. But if you had rebalanced your portfolio, your returns based on historical numbers would have been more than 500%. And I think this clearly shows the fact that rebalancing do help in overall returns over the long term. And of course, the last idea that the last key to actually protect yourself from future black swan events is really to have a systematic investment plan in place, because it's basically dollar cost averaging, and by doing so, you actually reduce the impact of market volatility because you're spreading your investments over a period of time rather than a lump sum investment. So I think the most important thing about this is that you basically take away elements of market timing, you take away emotions out of the investment equation. You don't make stupid mistakes of selling at the lows and buying at the highs. And last but not least, I think it forces investors to actually think long term. So this plan is also, I think, very suited for investors who are new, who are just introducing them to investments, or and that they don't really have the knowledge, or they don't have the capacity to actually monitor the investment regularly. So I think this is a great way for them to build their wealth. So the evidence of why systematic investment plan works, because if you look at the past, let's just take the worst economic event in history, the Great Depression. So so if you had invested in the market at its highest peak during the prior to the Great Depression, right, you would have only you only have broke even probably 30 years later, 20 to 30 years later, right? Which is denoted by the black line over there. And you would have actually experienced a maximum drawdown of minus 86% during this period. But, for example, if you had started your systematic investment plan during the peak as well, instead of putting your money in as a lump sum investment, you put it across a period of time, you realize that actually your maximum drawdown is not that low. So the blue shaded area is, of course, how much you've invested over time, and the red shaded area is your portfolio value over time, right? And you realize that you will actually have broke even just about 4 years later, in June 1935. You would have pretty much broke even. Another case study, the World War II event, same thing. You would have only broke even, let's say, about about 7 to 8 years later. But if you have used a SIP plan, you would have broke even probably just 2 to 3 years later. So just to conclude this very short presentation, this short time that I have with you guys, I think what I've shown over the various keys is that they all can help to improve your portfolio, whether it's from a diversification perspective or whether it's from a long-term return perspective. And I think the important thing is to not to cherry pick one tool and just because one is probably more convenient for you and call it a day. And I think you have to use all three tools together, because these tools are basically edges. By stacking all these edges together, it can help you increase the odds of investment success for you and your clients. And I think each tool has a specific purpose, and it gives investors a specific edge. So I think diversification definitely helps you with the risk-adjusted portion. When you think about portfolio rebalancing, it allows for, in a way, buying low and selling high, because you are basically selling your winners and buying losers over the long term. And this actually also ensures that your portfolio risk is kept in line with your client's investment preference, whether they're moderate, aggressive, or even conservative investor. And lastly, I think a regular savings plan, which is basically the systematic investment plan, it helps to create a better psychology management for your clients, because they did not invest their money lump sum, and that they're in this for a long haul. They know that they're in this for a long haul. The results show that if you're in this for the long haul, you're more likely to succeed. And I think most importantly, this will help to inculcate a long-term investment horizon, which I think is basically what's most important for investment success. Yeah, so I think for now I've come to the end of my presentation. I will have some time for 1 or 2 questions if there are any.
Are you able to see the question, Sean?
Wait, hold on. Well,
I'll read it out to you.
Yeah. While global diversification is great in reducing risk, in case of a black swan event, won't the correlations actually break down? Well, yes. As if there's a systematic global event, I would say that most equity markets across the world, their correlation numbers will basically be very, very correlated. Whether is it correlated to a degree of 1.0, 0.8, 0.5, which is why I think it's important for fixed income to be a part of your portfolio, even no matter how bullish you are right now because of the COVID recovery. I still believe that fixed income has still a place to play for your portfolio. Yeah, and which is why if you go back to the diagram, the football field diagram, you need to have all these fixed income segments. You need to have Indian bonds in your portfolio. You might also want to have some precious metals as well, because over time, over a long period of time, precious metals basically have a correlation of zero with equity markets. Yeah. Can you elaborate on the point where you said rebalancing helps you to lock in profits to recycle into laggards? So, okay. So I would like to, again, use the example of the football field diagram, right? Imagine the football field diagram is basically how you allocate your monies. And you basically put for example 5% about 25% of your portfolio in global equities, 25% of your portfolio in Indian equities, and maybe 50% of your portfolio in fixed income and perhaps precious metals. So let's just have this example where global equities did really well during this year, where they actually rose by 25%. Indian equities, on the other hand, only rose about 10%, and fixed income markets actually had a negative return of about 5%, right? So this is just an example. So by rebalancing, which is basically selling global equities at the end of the year, selling some of your Indian equities perhaps, and recycling these monies back into the fixed income markets. This is one way that you can actually rebalance your portfolio, assuming that you are a 50-50 balanced investor. Because the thing is, equity markets don't go up in a straight line. They go up, they go down, they go up, they go down. And therefore, I think by doing so, you're actually locking in some profits when they do well, and you recycle them into the ones that don't do well. Because at the end of the day, various asset classes work differently. They move in a different trajectory at all times. So when you do that, you lock in profits and you ensure that you are in position to actually make more money from the underperforming asset class. Yeah, so I think we have come to the time is running short, so I'll be passing my time on to Dipali. Yeah.
Thank you so much, Sean. It's been very, very insightful. Thank you.
Thank you.
I'd now like to announce a short 10-minute break, ladies and gentlemen, but please don't go anywhere, as our very next session is the key session of the day with our global model portfolios. We'd also like to open up our third poll for today, which is being brought by our knowledge partners, ARIA, Association of Registered Investment Advisors. Please do send in your responses, and I'll see you back in 10 minutes. Welcome back, everyone. We now move on to the key session of the day, the iFAST Global Model Portfolios. Our presentation will include 5 model portfolios that illustrate how investors with different risk profiles can go about building their global investment portfolio. This presentation is brought to you by Rachna Makhija, Senior Analyst, iFAST Financial India. Over to you, Rachna.
Thank you, Dipali. Good evening, one and all. I'm Rachna Makhija, Senior Research Analyst with iFAST Financial India Private Limited. Today, I'm here to present on Global Model Portfolio. So yesterday, we had a good session with Mr. Krishna Karwa, my colleague, who explained you about the Global Recommended Funds. Today, I'll be presenting on how to build a model portfolio with those recommended funds. Okay. So let us start with why model portfolios. We all know that asset allocation is a very important part of investment strategy, which is made in line with our investment goals and also the different risk tolerance levels. Now let us see what is the impact of diversification on a model portfolio. So here, as you can see in the chart, we have taken 2 indices. One is the MSCI World and the other is Nifty 50. So if one had invested for 10 years in MSCI World Index, he would have got a return of 12.8%. But again, in case of Nifty 50, which is a domestic focus index, he would have got return of 10.8%. Also, if you see the drawdowns, during the coronavirus pandemic, when there was crash in the global markets, MSCI World corrected by 36.5%. But again, Nifty 50 corrected by 42%. Now let us take a look at how different markets perform differently. Now, as you can see, in 2011, when there was correction in the global markets due to the European debt crisis, all the markets corrected. But the quantum of fall in all the markets were different. In India, Sensex fell by 25%, but again, Europe fell by only 15%. Also, if you can see here, for the 2020, the latest year, you can see that it had, all the markets had fallen. But again, the recovery that all the markets witnessed after the recovery from the crisis, it is different. Europe is in fact still struggling to recover as due to the second phase of lockdown in the economy. Now, as an Indian investor, one more point which I would like to highlight as an advantage when you invest globally is the currency movements. That is the returns that is generated to the specific index return due to the INR's depreciation as highlighted in the green. Now, for one example, as you can see in the year 2018, if one would have invested in US, S&P 500 here would have got return of 8.6% over and above the index return. Now, in case of Japan also, one would have got return of 10.2% over and above the index return. So also going forward, we believe that INR is expected for a structural depreciation due to various reasons like higher crude oil imports, higher inflation, and also due to RBI constantly buying FX to prevent INR's appreciation. Here's a list of recommended funds, which my colleague had already covered, so I would not be going into detail. But yes, these are the funds which we will be using for making a model portfolio. Now, how do we create model portfolios? Before that, I would like to highlight a few points. Is one, we have considered global funds as a core allocation. All the funds except for the Nifty Next fund is subject to debt taxation. In case of a regional continent exposure, there would be minimum overlap amongst the funds. And before investing, one should always consider the net returns, that is the returns less the expense ratios less the exit load. All the global markets are subject to volatility. One must always consider these times of volatility to increase their exposure. We advise to offer SIP and STP route, and please consider growth options for the respective funds. All the model portfolios will have 8 funds each. Here's the recommended asset allocation, which I was talking about at the onset of the presentation. As you can see, in case of conservative investors who are more risk averse, their allocation to debt is quite higher. While when you move down, move towards the risk curve, you can see that aggressive will have higher allocation to equities. Now let us look at conservative and moderate conservative portfolios. In case of debt, since we have a higher allocation, the durations across the curve are considered. Also, credit quality, that is the exposure to the AAA instruments, are prioritized. Dynamic funds are considered for the alpha returns, and the low duration funds will be helpful for minimizing the volatility of the portfolios. For the equity exposure, only global exposure funds will be considered. We'll look in detail in the next slide. So here's the conservative portfolio. As you can see, for the equity exposure, we have used two funds. One which has global developed market bias, and the other which has global emerging markets bias. We have not taken any region continent exposures while making a equity allocation to a conservative portfolio. When it comes to debt, we have considered four categories. Corporate bonds and banking PSU funds have higher allocations as they are well placed in the short to medium duration curve, and dynamic bond funds are considered for the alpha returns because of the durations, and low durations are considered for minimizing the volatility of the portfolio. Now let us go to the moderate and conservative portfolio. In case of this, again, we have not used any region exposures. We have considered two funds in two category, that is the funds with developed market bias and the other with the emerging market bias. In case of both, the allocations are a bit higher as compared to the conservative. Here also we have used four categories. Corporate bond and banking PSU have got higher allocations, and dynamic funds are considered for the alpha and low duration for minimizing the volatility. Now let's get to the balanced, moderate aggressive and aggressive portfolios. So here, as you can see, the debt, only short duration, short to medium durations are preferred, and low and dynamic are not considered. As for the alpha, we will be looking out for the equity allocations. Now, when it comes to equity, we have considered regional exposures, which is based on our underlying model, and star ratings are considered, that is our iFAST regional expertise. Now let's get into the crux of the model portfolio, that is the allocation rationale of the equity. So here we have used two factors. One is the market cap and the other is the GDP. We have given 50% weightage to each of the factor. So after that, we have arrived at a regional total of 48.4% to US. Again, as we can see that US is steeply valued and the growth cycle has almost played. That is the reason we have reduced the exposure to 40%. Again, for Asia Pacific, we have allocated 40%. As you can see that we expect a regional cyclical recovery where we look out for these continents, China, Japan and India, and thus the exposure is 40%. Again, Europe, where we expect the value play to move going forward. Thus, we have allocated 20%. So here our final allocation of 40% to US, 40% to Asia Pacific and 20% to Europe. Let's look at our balanced portfolio. Here where we have used the model to allocate the equity portion. So you can see that 40% is being allocated to US, 40% is being allocated to Asia Pacific and 20% is being allocated to Europe. In case of debt, we have used only two categories, that is corporate bonds and banking and PSU, which are well placed in the short to medium duration curve. Now let's get into the moderate aggressive. Here also we have made the equity allocation based on the underlying model. So 40% of the equity is being allocated to US, 40% to Asia Pacific, and 20% to Europe. In case of debt, we have considered corporate bonds and banking and PSU. Now let's go to the aggressive portfolio allocation. Here we have used the similar model, 40% of the equity allocation to US, 40% to Asia Pacific, and 20% to Europe. For debt, we have used only two categories, corporate bonds and banking and PSU funds. So once your model portfolio is built, we'll always think, when do we actually rebalance? So one, when there is any change in the regional star ratings. Second, when there is a change in the fund attributes, that is any change in the fund manager, any change in the fund strategy, that is the respective continent exposures. Again, if there is consistent long-term underperformance of the scheme versus its benchmark or its peers. And also when the risk profile changes, that is when a conservative profile wants to shift to moderate conservative. These are the stages when we actually will think about rebalancing. With this, I conclude my presentation. Thank you, everyone. Please post all your queries in the chat box, or please mail us at research.in@ifastfinancial.com, or please send us to queries to our BD team, who will get in touch with you. All the presentations and our reports are available at the iFAST booth. Please download and take a look at it. Thank you, one and all. Over to you, Dipali.
Thank you, Rachna. Can we now have the results of the third poll on screen, please? Wow. Okay. So the majority of people have responded that guidance with process and practices to set up advisory practice is the biggest gap area currently, where an RIA can get help. That's so true, actually. With all the recent regulatory changes in the advisory and distribution space, we're all in a state of flux. Not only regulations, actually investors are evolving as well, as they're getting newer digital experiences and they have more and more exposure. So the pressure to highlight value add as a service provider has never really been stronger. Now, iFAST Financial understands this transformation, and we have been leading this change in other Asian markets as well. I'm happy to present a sneak peek into our latest business model offering for both distributors and advisors, called the iFAST Global Markets. Let's take a look, please.
Are you wondering what the regulatory changes mean for your advisory or distribution business? Worried about net worth and licensing requirements? With iFAST, you can join Asia's largest network of independent wealth advisors to offer both advisory and distribution like a corporate registered investment advisor without getting a license yourself. iFAST is India's only complete wealth management platform with full support for multi-asset advisory, automated fee recovery, client-level segregation, and global investments. The inclusion of mutual funds, bonds, stocks, and ETFs allows you to service a wider range of clients with different investment needs. Our groundbreaking advisory fee calculation and collection process seamlessly across different asset classes help you build lasting relationships with your clients. Inbuilt support for both distribution and advisory models with client-level segregation allows you to grow your business in full compliance with SEBI regulations. With our international platform, you can differentiate yourself as a global investment advisor with access to the best stocks, ETFs, mutual funds, and bonds across the world. In this mobile era, much can be achieved without even meeting your clients face-to-face. With the iFAST Client mobile app, users can easily approve trades and track their goals and portfolios across multiple investment accounts with just one login. The iFAST Group is Asia's leading investment products distribution platform. Incorporated in Singapore back in 2000, We are now present in Hong Kong, Malaysia, China, and India. iFAST was listed on the Singapore Exchange Mainboard in 2014. Across Asia, the iFAST platform offers access to over 11,000 investment products and services, including online discretionary portfolio management services, research and investment seminars, and fintech solutions. Beyond online services, iFAST advisors also gain from exclusive AMC trainings and portfolio strategy workshops all year round. Our advisors obtain the latest information and portfolio strategies from our in-house research team and representatives from global fund houses. Our flagship event, iFAST Global Wealth Advisors Symposium, assembles experienced wealth advisors and other experts around the world to share ideas and best practices. We offer you tailor-made technology solutions to help you create an advisory practice of the future. Our technological expertise can help you embark on your own DIY B2C journey. You can also launch your robo-advisory solution at a competitive cost. At iFAST, we aim to help investors around the world invest globally and profitably.
I hope you all found that informative. Ladies and gentlemen, we do have an iFAST Global Markets booth under the sponsors exhibit area. Please do access that. Reach out to us if you have any further queries about this. At this point, we are done with our key previous sessions for the day, and we will take a short break before we come back for the breakout sessions. Like yesterday, we have 3 breakout sessions scheduled from 6:30 to 7:30. Some very, very interesting options for you out there. We have one session which is being hosted by our knowledge partners, ARIA, that is the Association of Registered Investment Advisors. Please do attend their sessions as they have 2 topics that they're going to cover. One is aimed towards the distributors and the other is aimed towards the RIAs. So the first half from 6:30 to 7, they will be talking to distributors and offering them insights on what they can do to transition their business. And in the second, they will be addressing RIAs to understand and exchange ideas on how they can work together to grow their business. Our other breakout session is with the American Academy of Financial Management of India, AAFM, who are also our knowledge partners at this event. This session is being hosted by Mr. Deepak Jain, who is the head of academics at AAFM India, and he will be talking about all the important information that a global wealth manager needs to know. Our third event is by our sponsors, ICICI Prudential Asset Management Company. They have the head of sales, Mr. Anirudh Chaudhary, who's here to interact with all of you and answer any questions that you might have. Please do attend the breakout sessions and make the best of this opportunity of interaction with these people. We shall all see you there in a short while. Thank you so much, ladies and gentlemen. I hope you all enjoyed the breakout sessions. And that brings us to the end of iFAST Financial India's Invest Globally and Profitably 2021. Thank you for being such a fantastic audience, for joining us, engaging with us, and making this event so successful. I'd also like to offer a vote of thanks to the many partners who made this event possible. Starting with our sponsors, Motilal Oswal Asset Management Company, Axis Asset Management Company, ICICI Prudential Asset Management Company, and Franklin Templeton Asset Management India Private Limited. Our knowledge partners, FPSB India, AAFM India, and ARIA, as well as our media partners, Money Control. I'd also like to offer a heartfelt vote of thanks to all of our speakers who gave so generously of their time and insights. You guys really made the session so much more valuable. Thank you. I'd also like to thank our many colleagues at iFAST Singapore, iFAST Malaysia, and iFAST Hong Kong for helping in so many different ways to make this event possible. I'd also like to thank our Managing Director, Eric Horn, for his vision that drove the entire event. Also, all of my colleagues at iFAST Financial India, your unstinting support and encouragement made this event possible at all. And last but not the least, I'd like to thank the super energetic and professional team at Eventos, our event managers. They pulled it all together for us and gave us a fantastic stage to host our event on. Thank you guys. Well, that's it from me, Dipali Lalwani. I hope to be back bringing you similar such fantastic iFAST financial events in the near future. Good night and goodbye. I hope you all enjoyed the breakout sessions. And that brings us to the end of iFAST Financial India's Invest Globally and Profitably 2021. Thank you for being such a fantastic audience, for joining us, engaging with us, and making this event so successful. I'd also like to offer a vote of thanks to the many partners who made this event possible. Starting with our sponsors, Motilal Oswal Asset Management Company, Axis Asset Management Company, ICICI Prudential Asset Management Company, and Franklin Templeton Asset Management India Private Limited. Our knowledge partners, FBSB India, AAFM India, and ARIA, as well as our media partners, Money Control. I'd also like to offer a heartfelt vote of thanks to all of our speakers who gave so generously of their time and insights. You guys really made the session so much more valuable. Thank you. I'd also like to thank our many colleagues at iFAST Singapore, iFAST Malaysia, and iFAST Hong Kong for helping in so many different ways to make this event possible. I'd also like to thank our Managing Director, Eric Horn, for his vision that drove the entire event. Also, all of my colleagues at iFAST Financial India, your unstinting support and encouragement made this event possible at all. And last but not the least, I'd like to thank the super energetic and professional team at Eventos, our event managers. They pulled it all together for us and gave us a fantastic stage to host our event on. Thank you guys. Well, that's it from me, Dipali Lalwani. I hope to be back bringing you similar such fantastic iFAST financial events in the near future. Good night and goodbye.